to me. And hey, everyone, welcome to this week's edition of Bulls versus Bears, episode 129. We welcome our the newest addition to the team, Philip Delockery. As I mentioned this morning, we'll bring a bit of class to the show. I'm not sure what class, but maybe, but Phil, welcome, mate. Welcome to the team.
Yep. Well, thank you, guys. Thank you for having me. It's an exciting time, great opportunity. And you have the class. I know there's probably more us than class, but anyway.
Yeah, possibly. Mate, you managed to survive this long. Kai,
what is it? Yeah, I know. I thought about pulling stumps last night, but there should be union rules. I can't work 13 hours a day at my age of 35.
Yeah, no, that's right. So this is just for people's context. Phil is actually only 34, and that's what he looks like after 20 years of trading. But
29. Okay.
Now, Kai, how you doing, mate? All good?
Oh, yeah, pretty good. A bit of excitement. Well, probably not exciting. More worrisome last night. The news coming out of the
volatility, which we tend to mistake for excitement. But so hyperscalers or hyperspenders, or they've turned into hyperspenders. We'll sort of focus on that, but we were going to focus on that quite a lot. But obviously as well, we've had this massive escalation in Iran, and not just Iran, the Middle East, because the Houthis have joined the fight, and the Bab el-Mandeb. I've been practicing that because it was really, I found it quite difficult. That's straight at the end of. It's similar to Hormuz. It's like as it narrows as a choke point. So two ships got pushed back by the Houthis yesterday, and that is a further sort of 5% And now everyone's got to go through the Suez Canal and out via the Mediterranean, which is a bit problematic. But this is what we're talking about this week. We've had earnings this week. Google and Tesla, both fairly horrible performance. Meta and Amazon pretty horrible as well, just on the back of the fact that I think like us, everyone sort of thinks that Google was probably going to be the better of the capex results, and it wasn't overly pretty, and they had their first negative free cash flow quarter ever apparently, and Tesla just reported bad, and it's a complicated business, and there was not. I think why it was down 14% last night was there was no update on Optimus, and there was no update on the robotaxis. And usually when it's quiet, it means that Elon's promised something that he can't deliver, which he is pretty good at doing. The oil majors, you can see, which are just to the left of Tesla there, have headed up a little bit higher. Still probably pretty cheap. Software not looking great near them in that Microsoft Meta region. But, the old stocks, Micron's still up 14%. SK Hynix is not in the S&P 500. It's only an ADR, but it was up. It was roughly the same as Micron this week. There were some pretty good reports from the defense sector. RTX and Lockheed Martin both reported last night, up 10% and 7.5% as well. And the financials sort of came off the boil a little bit. That's really with the ASX, we survived a hell of a lot better because we don't have that tech. Phil, you spotted a couple of things this week, particularly momentum wise. What were the stocks again?
One of the two mains was South32, which they had a good quarterly update, and they also they had an asset sale to Alcoa, the aluminium business, and the market liked that. And technically, they traded very well after the quarterly update. They basically got sold off. Usual thing, buyers came back in when they realized it was really good. It closed on its high. And then technically for 3 days in a row, it just kept closing on a high. And so I thought that was, great trade, great, stock technically to look at. And another one, which is the older traders, I'll show you the more mature ones, they're going to cringe is AMP. So you might call Lazarus come back from the dead. It's, I think back in March 2026, it was $1.14. Now it's at $2.12, $2.14. They had a good earnings upgrade guidance. And I think that was from 130 to 180, which is pretty big. And that was due. They've actually done a partnership with Chinese pension funds. And once again, that's traded well, broke out and sort of kept going. Now it's up to your 220 level. Will it keep going? And also another fact, they've got a very good banking product for anyone out there. Thank you, Mum. She found it, and it's called AMP Go, and it pays 5.1.
Yeah, well, we were even looking at AMP. Well, I've had a look at it previously.
Yeah.
We just haven't really got around to it because Kai and I have been pretty damn busy. But it's like a 5.1%. Like it's designed for small medium enterprises, and
you're not you're not locked in. There's no term to it.
No,
I'm surprised they're not doing any advertising. I've never, I haven't heard anything about it. And I found
Shane Oliver had turned up to, if his daughter or if his kids had a video camera on. So I'm not entirely sure how they get in the media a fair bit, but it's a good product.
I mean, Macquarie, everyone knows their cash management, but AMP. Yeah. Just one last thing on the ASX as well. We noticed the SaaS apocalypse is sort of coming back, hasn't really bounced. Even PME, I think, dropped from probably 210 to 153 today. Xero's getting
down about 15% as of yesterday.
Yeah, so they're not bouncing. So is it also nothing to bring up quickly? We had a very strong employment number, supposed to be up 30.
Oh yeah,
it was up 76. So it looks like there's going to be another rate hike, almost certainly. If not the next one, definitely the next one after. And so that probably plays on tech stocks. It does. So. Yeah. So,
well, I mean, there's
a lot of stuff out there.
Obviously, oil at $100. So, like inflation.
Yeah. Exactly. So, look, there's a lot of headwinds out there. A lot of stuff that So how trying to sugarcoat it a bit, don't I? Yeah.
Well, look, I think if anyone watched the morning call this morning, I sort of finally broke. There's the old rule in stocks and stockbroking and blah blah blah. Is like bearish doesn't sell. But this morning I'd had enough, and I just was like, this is gone now. So I'm not gonna. There'd be no more sugarcoating. But just in terms of like, there's you can bury your head in the sand for so long, but generally we've always we had the hyperscalers save the market for 18 months, and then the memories now the socks are saving the market. It's like, but this hyperscaler thing particularly is, which will be the next slide. Let me just quickly run through this. I mean, ASX was actually okay for this week. Obviously down today. So this is as of Thursday close, not of. We just do Thursday to Thursday because we can't get the Friday numbers before we record the podcast. But that's obviously the tech down. China made a bit of a recovery, and China Tech made a bit of a recovery because people are looking for diversification, and they've got much cheaper models. And the ASX, I think what they call the old widowmaker trade, where you long here and short the US, which is a bit of an old, Phil and I particularly have known each other for 30 years. We've seen about 100 blokes go out the back door trying to do that trade. But in this situation, I think the ASX is probably, it is a bit more of a value market, real assets, etc. And so the technicals on the hourly and the daily have kind of turned a little bit for the Dow, the S&P, and the Nasdaq. But I mean, still on the weekly, not too bad. And we had a look at 150, 100, and 200-day moving averages and a lot of the on a lot of the biggest stocks in the S&P 500, and there was a lot of them that were breaking down through those long-term 200-day moving averages, which is never good as well. But Kai, given you're our resident AI expert.
Mark, look at the Nasdaq; it's all like a bull bottom.
Oh, is it? Yeah, right. Yeah, so it is the Nasdaq would be sitting on that 200. Will it or?
Really, it's right there. Breaking that would be interesting. Yeah.
Yeah, so that's never good. So for those of you who don't know about that, I did put out an education article this week on how moving averages work. So just go to the website, go to the education part, and click on that, and you'll kind of, if you don't know what we're talking about, you can obviously go and read the article. But Kai, capex, we thought this was going to be the good one.
Yeah, no.
And that negative free cash flow bar. But look, I had a few people ask, can you, firstly, not only your tech background, but your sort of financials and actuarial background. Firstly, explain free cash flow and why it's so important, and then run through. obviously they had strong growth and things, but obviously it's been offset by it. But mate, yeah, go run through the Alphabet earnings stuff.
Yeah, no, exactly. Like, capex is really interesting to see in this age of AI build outs, right? So if you really look at it, I mean, all these cloud providers, they need to build infrastructure to serve the demand for AI. So like every time you use, a token when you're using Claude or whatever, GPT, any of these AI models, you need compute, and these things need infrastructure. Like, say for example, here in Australia, like Goodman, XDC, they're building the infrastructure to warehouse these, and you need to put computers in there. So like, servers and GPU racks and all this stuff in there. So all these guys got to spend a lot of money to build out the infrastructure, and it's been going on, for 2 years really at scale, right? Because it's really ramped up from pretty much 23, where GPT first came about. There's I'll talk about the top 5 players. I know there's a lot of other GPU inference cloud providers like DigitalOcean, or in Australia like Megaport and etc. So but I'll leave these smaller ones out for another time, and we'll just have a look at the top 5 in terms of what's happening, right?
We've got here, and I'm gonna have to. I forgot to do the key for it, but Amazon's kind of the gold one.
I'll run these. I'll run through these figures, right? So I've got it on the table here. So basically, with AWS, right? Like, just to give you a bit of perspective, before the AI age, Amazon was doing about 40 billion in terms of capex. Microsoft 15 billion. Google, they're all around like the 10 to 20 billion dollar mark. Oracle, I'm going to chuck in Oracle there because it's a good. Well, it's an interesting one to look at as well, right? So Oracle was spending about $2 billion in terms of capex in about 2020. And I'll give you the latest financial year figure, right? So basically, Amazon's done about is doing about $131 billion in terms of capex. Google, from Microsoft and Meta's doing about 60 billion. Alphabet's 90 billion, and Oracle is doing 55 billion. So Oracle is really, really making a big bet here, right? Because like the main thing we're talking about here is it's a long-term build. Look, they're still going to build out the infrastructure for another 2 years at least, right? So they're committed to big spend for the next 2 years. And, I think, the case of saying whether AI will be a thing or not, or whether it's going to be in demand, is put to rest, right? Like, I think we've all seen what it's used for, and it's going to be here. But the question is, I think from a company standpoint, it's really like just seeing who's making a really risky bet, right? And the clear standout is, of course, Oracle, going from $2 billion from 5 years ago to about 55 billion. And as a multiple, it's 26 times, right? Like all the other guys are spending about 3 to 4 times.
Yeah, they've loaded up so hard.
Oracle,
and they're at 52-week lows.
Yeah, exactly. Because like looking at the other figures here, right? Like, okay, so give you an idea, Oracle, they make about 67 bill. Their 1 year capex is 55 bill. So they're basically spending all their rev on capex, right?
Yeah.
Because if you really put it into perspective, like Amazon, they make 716 billion in rev, right?
I think they've got the most amount of rev of any company in the world, I believe.
It's high. Yeah, definitely high. Yeah, exactly. But their margins are a little bit thinner, right? Because their operating income's at about 80 billion. Their operating cash flow is about 140 billion. So like they're going aggressive, but basically, all of them, like say Amazon, Microsoft, Alphabet, Meta, they can afford this, right? They're making a big bet, but they can afford it, right? Oracle is making a bet, and it's just crazy.
Well, credit default swaps are very widely traded on Oracle. And that's credit default swaps didn't they were obviously made famous by Michael Burry and and things. But they hadn't really, they hadn't really been around for a while. But and I accidentally did cut off. So this doesn't make a lot of sense. But the dark blue is Microsoft. The light blue is Alphabet for free cash flow. The grey is Meta, and then the gold is Amazon. So Amazon has gone into negative free cash flow before, and they don't really bother. But I think it's because their revenue is so consistent. But all of them next year. And this doesn't even include Oracle. All of them next year are expected to be negative free cash flow. And some companies will get smoked, but I think what's concerning for next week is, Apple's going to be fine because they've actually managed to turn being lazy on AI into a win. So they're quite well supported. But Meta, Microsoft, and Amazon are the three that, we were probably the most concerned about, because Google's pretty good. Like, they've got their inference chips. They've got they don't pay up like the rest of them do. They've got quite good infrastructure.
Yeah.
And that's leading it. That's coming out of a FOMC decision as well, which is popped back up to being about 35-40% chance of there being a hike, which is again problematic. JGBs are at 40-year highs. Every bond market in the world is sitting at, I think the 30 years real yield, which I'm assuming they're doing off the tips, the inflation index ones, is the highest it's been since 1995. And then you've got 10-year yields are the highest since in 18 months. And and oil just keeps going higher. Like Brent's at $100. Yeah. We're at $92 in crude. So it's next week's a risky week, like super risky. And everyone's kind of cool, as Kai said, spend when you're making money, but if the market starts to slide a little bit, things might. And we look, 2 weeks ago we were discussing that margin lending and things. I was just blown away by the fact we did that episode 2 weeks ago. Retail margin lending was 1.4 trillion. By Wednesday this week, it was beyond 1.5 trillion. So they just added another $100 billion to it. And then the 3 times ETFs as well, or the 2 times ETFs. You add to that on top. So we're, a little bit, and there is some pretty decent numbers out next week. We got RBA Tuesday, FOMC Wednesday. Well, that might be, it might be Thursday morning, but it's Thursday morning at 4 a.m. And then you've got Aussie CPI, and then you've got preliminary GDP and core PCE on Thursday night as well. So next week's huge in terms of potential market risk. And then you've got the weekend and Trump said they're going to launch a massive attack on Iran over the weekend. So because he's not happy about the Houthis joining the fight. So, and I think he said he's going to attack the Houthis as well. So, and then and he's announced tariffs again. Like Australia got tariffed today. And a bunch of the world.
We couldn't work out what the tariff was on.
Yeah, it was the same 10% tariffs he tried to put on everyone, but he's put it under a different technicality that it's called forced labor laws. And because we don't have a law against forcing someone to do a job, like forced labor, we don't qualify. So we got the 10%. So unless you've got an actual law in place, apparently, because I couldn't work. Phil and I were sitting here this morning trying to work it out, going, what the hell does that even mean?
Well, Mark, you forced me to take this job, didn't you?
Yeah, no, absolutely, mate. I was no, I'm going to leave that one alone.
No, that's so.
No. I had a joke in my head. It's probably not appropriate for the podcast, but anyway.
Just give me a 10% pay cut, yep.
A 10% pay cut, yeah, righto. Everyone heard that, right?
No.
Exxon Chevron at the end of the week. We've got Rio and Fortescue here in Aussie, and then our earnings season essentially kicks off from the following. I think the following week it starts to get which ASX earnings season is judging by the last few isn't a lot of fun either, to be honest. So gold and silver were going okay this week until the bond yields went straight back up. But I mean, look, crude in the middle is the only one we all need to be looking at the end of the day. I think that's the big one.
We caught it, and you know, like going back to a couple of weeks ago, right? Like I think, it was a little bit of a missed opportunity. We didn't go harder, and it's like just looking at that setup, and I don't know. I just keep looking at it, going like, oh my god, it's such a. We should have went much harder.
We've got Chevron, and I still think, and to be honest, I think Chevron's still cheap. One thing Phil and I looked at this afternoon, because so for those of you, it's a small website, but I quite like it. Anthony Black's a lovely fellow who runs the site. It's been going for years, called The Bull, and you've got to give advisors give 2 buys, 2 holds, 2 sells. And I wrote mine for next week. A little bit of it. Well, I'm not going to call it an exclusive because Blind Freddie can tell you this, but we looked at Qantas, and Qantas is still like sitting up towards highs, right? Like, and it just keeps like jet fuel's in much worse shortage than crude. So I think that like Qantas and Virgin have got I would say a pretty rude, but that just shows you how complacent the market is. And we discussed this earlier in the week, Phil. Yeah. Like, you brought it up separately because I wrote an article on Livewire, but you said, like, it's always scary when markets are complacent like this.
Yeah.
Like, they think it's just going to keep rolling on, and
yeah, absolutely,
and it kind of is.
They both use the same word. Yeah. Yeah.
Which is rare. Yeah. There's lots of words been flown around, but rarely they're the same. Now, so this is Bab
it's like you're walking down the street whistling, then all of a sudden.
Yes. All of a sudden, they shut the Strait of Bab el-Mandeb. I'm so proud of myself for finally getting my head around that. And if I'm pronouncing it incorrectly, your feedback is not welcome in the comments field, people. I'm just going to keep going with my Australian version. So obviously, the Suez Canal being at the other opposite end of the Red Sea, and but it pretty much blocks things off. But what you've got to realise is then you've got to go through the Suez Canal, out the Mediterranean, all the way around Africa to get to Asia. And and poor old Pakistan, who has a massive fuel shortage, is they're right next door and they can't get anything. And like, it's adding something like 6,500 nautical miles, or 40% to the cost of the trip. So it's not good at all. And then obviously insurance goes up there as well, because one of the big reasons they did the Suez Canal is like is it Cape Horn? Is it that's
South Africa? Yeah.
It's like one of the most dangerous areas for ships.
The bottom's Cape Horn. I don't know where it comes.
Yeah, the bottom. Is ships don't like going down there. Apparently, it's super dangerous. But it's not just a bad month for petrol prices. So if with both of these shut, because a lot of cargo goes through the Suez Canal as well. So this is not just an oil story; it's also a cargo story. In terms of everything, usually goes from Asia, particularly manufacturing, through Suez to the Netherlands. Most stuff goes to the Netherlands. It's like it could potentially be 0.7 to 1.5% add to global inflation month on month. And at that point, God knows what happens to rates. So I think we're very much underestimating what's happening. And then add to that, the US has got, this is measured in days. Their oil reserves are the lowest in 45 years. So they've got 45 days left because they've been lending to the refiners as well. So, Trump, this weekend's obviously pretty important, whether he decides to try another peace deal or whether he decides to bomb the crap out of them, I suppose, and try to finish it quickly, because that number there is not good. And gas prices a gallon are at $4.10 again in the States, and $6 for diesel, because diesel's in even further shortage as well. So, we're high levels of cash and not what's the
Mark, I'm hearing there's good.
Yeah.
Oh, so there's a good chance. I'm hearing there's good chance there's going to be real supply issues here around September, October. Someone I know quite heavily connected to the oil industry. So there's no great surprise, though, is it?
Well, no, but I mean, hopefully.
That's another thing to look forward to.
Well, hopefully Viva's factory's back up, or refinery's back up and running and killing it by then, because apparently most of those fires are due to the fact that they run them too hard to take advantage of prices.
And also one more thing, I think that we didn't mention before. It's one more thing to mention before as well, to add to the list of catastrophes, is basically Trump's Trump's nuclear deal with Saudi Arabia, right? Like, I think it's quite big, because it's from a strategic point of view. Obviously, Saudi Arabia is the staunchest US ally in the region. But it really adds a bit of fire to the fuel, right? Because, like, obviously, they're saying they're giving the nuclear technology to for power plants and so forth. But it does, bring on the question of, will they enrich uranium, or adds that, question mark into the equation. And
it's double standards, right? Like they're not letting Iran do it, for the same reasons. But I didn't even. Yeah, that was there's been so much news this week. It's been incredibly hard to keep up, and you and then I'm listening to Bloomberg Radio and Reuters and everything on the way to work, and they're going, oh, look at the SOX. Oh, Micron's up. Intel, it's quite frightening how much they can bury their heads in the sand. So, Phil, we're going to have to explain this to you, and we haven't explained this for a while. So, essentially, the chart at the start here, where where the light blue net change on the week. So, basically, you live or die by whether it's up or down. It doesn't matter how right you are. And you basically got to, and that's Thursday to Thursday, and you got to give your whether you're bullish or bearish. I've given you JT's score because I can't start you on zero, and to be honest, he had to put 4 weeks of tips in ahead when he went away on holidays, so he's been a little bit disadvantaged. And don't be afraid of a slow start. I was 1 from 8 at one stage, and and when we started this competition, so and Kai was in a clear lead. It's only been recent, but we got the fear and greed indicator. It was 42 last week. It's 40 this week. It's not much of a change. We were all bearish last week, so we were all correct. Now JT, having put his in, has a chance to pick up a point on us all because we're all bearish. And given you like myself and like Kai. Well, I'm probably a bit more of a rusted on bond trader. I think Kai's got a bit more common sense than me. But bearish was a fair bet, and particularly considering what's going on. So just make a pick every week and see how we go. And hopefully half of the decisions this year, 27 weeks in or whatever, have been made by under 0.5%, and about 10 of them have been in around 0.1%. So it's a little bit more difficult than when I came up with the grand scheme of doing this. I probably underestimated the winner, glory and appreciation. Or I can probably present you with the bear with me. With the trophy of the bull and the bear at the end of the year. You'll get your name etched right here on the rump of the bull. Talk
about being under pressure now.
Yeah, I know, mate. I know. It's cakewalk from trade. Now, I got some correspondence this week from our resident tourist, Jonathan Takadena, on his National Lampoon's NPC Markets research vacation of Southeast Asia. He sent us a research update because he's been in Japan and Vietnam. So we're going to just run through a little bit of JT's correspondence over the last week. He sent this through, and what he's learnt so far. So he visited a steel place, in Vietnam. Apparently they export 10 million tons of steel and iron, massive producer. And Vietnamese steel consumption per person, higher than the global average. They've got a massive construction boom going on. So there's JT, just lifting some steel. He visited Samsung Electronics factory as well. They're now the second largest smartphone exporter in the world. Samsung's got a massive operation there, and in the north of Vietnam. Foxconn, Intel, LG, Apple, they're all heavily invested. So that's just JT helping out, assembling some stuff. Pretty sure it was a missed call on Kai's phone because he didn't know what the hell he was doing. But overall, he eventually found his way. Here he is. It's he's in the rice paddy with the agriculture. They're the world's second largest coffee producer, and the Mekong Delta is the country's rice bowl. But he's got to wash that suit just quietly. It's in every picture. And then here we are in Japan. He's lined up in Japan, in the Toyota factory. Fun fact, it used to be called Toyota, and now it's Toyota. Because it's the spelling is now 8 strokes in Japanese characters, which is a lucky number, and it sounded smoother. So, so there's JT, obviously, behaving himself in the Toyota factory. They're pretty stringent guidelines over there, but they basically invented the high quality manufacturing production line. Here's JT reporting at a Bank of Japan meeting. He's just in the background there. Hopefully he's looking over the governor's photo, the governor's notes, just trying to work out what the hell's going on with the yen intervention coming up. He's pretty grumpy because he's had to raise rates for the first time in 30 years. But, hopefully when the media embargo comes up, JT can send us something through. And finally, tourism. There's JT. He's involved in Japan smashed records in tourism. He finally got that suit off. It's 42 million international visitors, and first time it ever topped that many visitors. So he's just looking beautiful there at the moment with his parasol happening. So that was really that's his research update. That could almost officially make his trip tax deductible now. But I just thought we'd better get a bit of an update on what he's up to, and what the sort of high quality research he's sending back to us. But MPC markets, we still have buy the dip on. So now everyone, you've got till Wednesday essentially, and if you're holding S&P ETFs and things like that, just do yourself a favor. Just go. You can go to it's on the homepage at the moment as well. But you can go to that link. You can scan that code, but have a look at it because it's very capital efficient. It's very it's good for risk used in the right way as well. You don't have to put down as much capital, and then we built in a mechanism basically where if we do dip over the next 4 months, you will get basically your entry price will have the benefit of hindsight basically, and you'll get that your entry price for the for the 3-year period will be dictated by that lowest weekly close on the nominated day. Which, look, if we do get that short, sharp dip like we did in Liberation Day, you effectively end up getting in 16, 17 odd % better. And we do have that midterm election cycle thing happening as well. We've got all of these risks coming up. So, look, I mean, apart from the fact that we think it's better than just holding an ETF, like the ETF's kind of like the horse and cart versus a Formula One car to this thing. It's, very well risk managed, optimized on the entry, I just do yourself a favor and go and have a look at it. Download the PDS. I'll leave it up to you. Won't give you the hard sell, but I think for the current situation is it's our best product that we've got. One of our best products, certainly for the index. It's available for retail and wholesale. Phil, actually, it's always good when you're a client as well of MPC and come on board. We've obviously known each other for a while, but you've invested in this because we all know that, how easy is it to buy it when it's down 20%? It's not at all, because you think the world's
exactly.
So,
the great thing is the hindsight thing as well.
Yeah, I mean,
the look back.
Funnily enough, explaining the hindsight thing to our trader mates has been the hardest thing in the world, because they're like, "How the hell why would you? No, you can't do that." And I'm like, "Oh, well,
look at yesterday's paper, yesterday's stock prices."
Well, exactly. Well, no, tomorrow's stock prices.
Tomorrow's,
but yeah, look. It was purpose built for this. Kai's done a lot of work on it to reduce the costs and things as well, and vol targeting and things like that. It's a great product. Like, please go and have a look at it, because it will do your portfolio a great deal of favors. We managed to keep it at 35 minutes this week, gents, which was pretty good. And I mean, mind you, we probably had a bit more on the other hyperscalers, but you can go to Mosaic. We've got our watch list up for US earnings season on there. You can probably, I think you get a couple of, you can go to the website in the news section and probably get it as well. You get a couple of articles before you've got to pay for Mosaic. We've got a full sort of watch list and roadmap for earnings season coming up. We've spoken about in the last couple of weeks. But gents, thanks for joining us. Phil, welcome. You actually did bring some class and some actual useful information to the ASX section. Not quite as high quality as JT's research project, in Southeast Asia, but
Mark, that's a high bar to set.
It is a very high bar to set. And look, I didn't even ask him for it. Like, he just sent it in. But everyone have a great weekend. And look, if you, as well, we got a couple of portfolio reviews through, and I kind of understand why through the website. For those listeners, there's a button on the homepage. Go to the homepage. You can submit your portfolio. We've got the Prism software. We can run it through. It's free, and we don't hassle people. We hate sales people as well. So we're not going to hassle you afterwards, but it's a good thing to do, particularly if you're a little bit concerned about things at the moment. So mpcmarkets.com.au. Boys, thanks again. We will, we'll see how we go next week. And for all the viewers, thank you very much for joining us.
Stay safe.
Have a great weekend. See ya.